Good day, ABM Business Finance learners. In this video, risk in investment will be discussed. The most essential learning competency for this lesson, the learner will be able to measure and list ways to minimize or reduce investment risk in simple case problems. As stated in our previous lesson, risk is concerned with the uncertainty that the realized return will not equal the expected return. But what is investment risk? It is a measure where the chances of an investor will not be good as it is expected. In this, there will be a possibility of losing all the money invested or some of it. We have two classification of risk. The first one is the systematic risk. Systematic risk is a type of risk that is non-diversifiable, means it arises due to external and uncontrollable factors, and its uncertainty inherent to the entire market. And the second one is the non-systematic. Non-systematic risk is a type of risk that is diversifiable. The results from known and uncontrollable factors, and its uncertainty comes from the specific company or industry. We have types of systematic risk. The first one is market risk. Market risk arises due to changes in demand and supply which affects market prices movements. The second one is the interest rate risk that arises due to market fluctuations in which the interest rates rise after the investor buys. The third is the liquidity risk. Liquidity risk is associated with the uncertainty created by the inability to sell the investment quickly for cash to meet the short-term demands in the company. The next one is the currency risk. Currency risk arises from the change in price of one currency against another, followed by inflation risk or purchasing power risk. Inflation risk or purchasing power risk refers to when the purchasing power of the return earned on an investment has declined or risen as a result of inflation or deflation. Then the last is the social, political, or legislative risk. Social, political, legislative risk is a risk associated with the possibility of nationalization, unfavorable government action, or social changes resulting in a loss of value. The next classification of risk is unsystematic risk. Unsystematic risk has four types. The first one is the credit or default risk. It is where the borrower will be unable to pay the principal as well as its interest. The second one is business risk. Business risk, it is due to volatility of revenues and profits of a particular company due to its market conditions, product mix, input availability, competitive market condition, labor supply, and others. The third is the financial risk. This is due to financial structure adopted by a company. Also arises because of short-term liquidity problems, shortage of working capital, inefficiency in collection of receivables, budgets, funds tied in excess inventories, long operating cycle, and others. The last risk is the management risk. This is due to the decisions of the top management, like product innovation and product methods that would also affect the business risk and financial risk. Risk infiltrate financial decision making. That is why financial manager or investor is required to analyze the possible outcomes and assess the investment's risk. Quantifying risk is an important activity as it assists in placing risk in some order of priority and highlights decisions to be made. In quantifying risk, we need to measure it. The ways of measuring risk are the following. The first one is the range. The second one is the standard deviation. The third is the coefficient of variation. And the fourth one is using beta. For this lesson, we will focus on the standard deviation and beta. Beta measures systematic risk and performance. And the formula for this is beta is equal to covariance divided by variance, while standard deviation measures total risk, both systematic and non-systematic risk. And the formula is standard deviation is equal to the square root of the sum of I up to n multiplied to x sub I minus x bar or mean squared over n minus 1. Once beta is computed, it should be interpreted. The beta interpretations are: if the answer or the beta is equal to 1, the investment's price will have the same volatility as the PSEI. PSEI means Philippine Stock Exchange Index. And if the beta is greater than 1, investment's price will be more volatile than the PSEI or the market return. And if the beta is less than 1, investment's price will be less volatile than the PSEI or the market return. For example, when a company has a beta of 2.3 and PSEI goes up or goes down by 10%, the company's stock price on the average will go up or down by 23%. The company with a higher beta is more volatile while the company with a lower beta is less volatile. The formula mentioned earlier may not be reliable if its data is for a short period of time. A 5 to 10 year period is suggested to have a better results. In interpreting standard deviation result, the lesser deviation, less volatility, the lesser the risk. The higher deviation, the more volatile, the higher the risk. Let us take this example in computing beta. We have here the monthly return of the Fabi and Glami company stocks and the market index from January to June. So for January, the stocks return is 20%, for February 14%, for March 33%, for April 10%, for May we have negative 7%, and for June we have negative 17%. And the market index for January we have 22%, for February we have 10%, for March we have 13%, for April 11%, for May negative 3%, for June is 5%. The first thing that we do is to solve for the mean. How to get the mean? Get the sum of the F and G monthly returns and divide the total population, which is 6. 6 are the months indicated in this problem: January, February, March, April, May, and June. So 6 months. So 53 divided by 6 is 8.833%. The next step in computing beta is to solve for the average market return. How to get this? Get the sum of the market index monthly returns and divide the total population, which is 6. So 22 plus 10 plus 13 plus 11 less 3 less 5 is equal to 48 divided by 6 is equal to 8%. Next is to solve for stock return deviation from mean by subtracting the stock's average return from individual monthly returns. So for example, we have here January. So for January, our individual monthly return for January is 20%. And we are going to less the average stock return. So the average stock return is 8.833. So the answer is 11.167%. Next is for February. February, our monthly return, our stock monthly return is 14%. Our average return for 6 months is 8.833%. So, our stock return deviation from mean is 5.167%. Now, you do the rest. The next step is to solve for market return deviation from mean by subtracting the market average return from individual monthly return. So we have here for January. For January, our market index return is 22% and our average market index return is 8%. So 22 minus 8% is 14%. Okay? And for February, our market return, market index is 10%. Our average is 8%. So our deviation from mean is 2%. Okay? Now do the rest. Okay, to compute for the product deviation, we are going to multiply the deviation from mean of our stocks and market return. So for January, we have 11.167%, and for our market return, we have 14%. So our product of deviation is 1.563%, or in decimal, we have 1,563 hundred thousandths. Okay, so let's proceed to February. So February we have 5.167% multiplied to 2% is equal to 0.103%, or in decimal we have 103 hundred thousandths. Now do the rest. Once you have computed the product of deviation monthly, add the product of deviation for 6 months. The next thing that we do is to square the differences, okay? The deviation from mean from our market index. Okay, we have here for January, we have 14%. To convert this into decimal, this will become 0.14, and square this, so we will have 0.0196. And for February, we have 2%. Let us convert this into decimal. This will become 0.02, and let us square this. We will have 0.0004. Okay, now try the rest. Once you are done computing the square deviation, this one, add the squared differences, and we will get a sum of 0.0524. We already completed the table, and we already have the needed information for our next step of computing our beta. Having this information, we are now going to solve for the covariance of our stock and market return. So to get that covariance, we were going to multiply the sum of product deviation to 1 over n minus 1. So our sum of product deviation is 0.08010 times 1 over 6 minus 1. So our n is 6 because we have 6 months. That is our population. So our covariance is 0.01602. Now the next step is to get the variance of market return. And to get that, we are going to use the formula sum of the square deviations in our market return over n minus 1. So our sum of the square deviation is 0.0524 divided by 6 minus 1 or 5 is equal to 0.01048. Now, we can now compute our beta. So, beta is covariance of our stocks and market return divided by variance of our market return. Now, let us substitute. 0.0162 divided by 0.01048, our beta is 1.55. Rounding off the beta will be 1.55. Okay, to interpret this, so since our beta is greater than 1, it indicates that the securities price or the Fabi and Glamis stocks price tends to be more volatile than the market. So if the market index will go up at 10%, the Fabi and Glami company stocks would go up by 15.45. So if it goes down by 10%, it means it will go down by 15.45%. Let us now proceed to standard deviation sample. So we have here in the table the yearly return of our stock ABC and stock 1, 2, 3, 4, 9 years. In the sample, the average return over the 9 years is the same for both stocks, and that is 15%. But annual returns differ. So stocks ABC individual returns were close to the average return. Okay, so the worst year generated is 13.5% return, while the best year generated 16.5% return. So none of the individual returns deviated from the average of more than 1.5%. So in stock 1, 2, 3, individual returns differ from average return ranging from 11% to a high of 19%. With the exception of year 5, okay, so year 5, all the returns deviate from the average of more than 1.5%. So, which stock is riskier? To know the riskier stocks, we will use the standard deviation. Okay, to know which stock is riskier, let us compute the stock ABC. Okay, so to compute this, subtract the average return from individual observations and square the difference. So for example, year 1 we have 13.5 less 15% average is equal to negative 1.5%. To square this, we will be having a value of 2.25%. Okay? Now for year 2, we have 14% less 15% is equal to negative 1%. To square this, we will be having a value of still 1%. Now, try to compute the rest and also compute for the stock 1, 2, 3 for comparison. So when you're done, let's proceed. Add the square differences. For stock ABC, we have a sum of 8.1250%, and for stock 123, we have 87%. The next step is to divide this sum by the number of observations less 1. So for stock ABC, we have 8.1250 divided by 8. We will be having a 1.0156. And for stock 123, we have 87 divided by 8 is equal to 10.875. The next step is to take the square root. So for stock ABC, the square root of 1.0156 is 1.01, and the square root of 10.875 for stock 123 is equal to 3.29. Now the last step is to interpret the result. So the result is, for the question, which stock is riskier? So stock 123 is riskier than stock ABC. Since we have already discussed on how to measure risk or to quantify the risk, how are we going to minimize and reduce the risk in our investment? So we have here ways of minimizing and reducing investment risk. The first one is to determine your tolerance. So be modest and conservative at your investment if net worth has an impact to your financial position and lifestyle. Next is understand, or you have to understand the different type of or combination type of risk in every investment. Because every investment involves some level of risk, it is essential to understand what type of risk you are going to undertake. Next is do your own diligence. So do not rely on anyone else. You have to personally check investment history, earnings, and growth. And then the fourth is research about your investment before you have them. Research, research, and research before finalizing your investment plan. And fifth is diversify your investment portfolio. So they say do not put all eggs in one basket. If your other investment is at risk for having lower return or at loss, but your other investment is at its peak for having high return, this strategy would reduce the overall risk of an investment portfolio by spreading it over a variety of products. And then number 6 is monitor your investment regularly. So it is necessary to keep an eye constantly on how your money is doing in the market to improve alignment with your investment goals. And last is consider time in investing. So time value of money. You should start early. The longer you invest your money in the market, the higher is its possible return. Thank you.